Us right now in the markets is Lori Calvasina. She is RBC Capital Markets head of U.S. equity strategy research. We're already looking at 2026. Things have been pretty great this year for the markets, even though it was kind of a scary ride up. You had the April situation with the tariffs that spooked everybody, and it's been kind of a fought upside battle since then.
Right, it's been a roller coaster. I mean, and while roller coasters can often be fun for some people, not for me, frankly, you don't necessarily feel great when you're sort of sitting at the top of the next hill. And it's interesting.
Is that where you think we are right now?
I think we're going to have a good year. I mean, frankly, this 5% drawdown we had in the a month or so ago, I wish it had been a little bit more just to get a little bit more of the froth out. There's still a lot of angst out there. I keep using the word, well, we have to be vigilant on this, we have to be vigilant on that. But at the end of the day, I do think we're going to have a good year next year. So we've got a 12-month price target on the S&P of 77.50.
Wow.
At the time we put that out right around Thanksgiving, I think December 1st we put it out, it was a 14% gain, right? So we've rallied back. That return has come down a bit. But as I talk to people, I keep saying, look, we could still have some indigestion. Even getting a 5 to 10% drawdown at some point next year, I still think we can make our 77.50 number. Our modeling goes all the way from 7,200 on the more conservative end when we bake in GDP forecasts. When we do our valuation earnings work, we can get you all the way up to 8,000.
Well, that's what I was going to say. Earnings, just watching the earnings that have been coming in and what you expect from here.
So the bottom-up consensus, which frankly I think is the best way to do it, because I think you have to do this work stock by stock. Macro-wise, we can't tell you what's going to happen in tech margins or biotech margins. And the reality is 13% earnings growth is not that heroic. A 14% return right on top of that, that's actually telling you there's not going to be a lot of multiple expansion, right? That we're going to really be queuing off this earnings environment. And, we're still seeing some good numbers. If you look at the rates of upward revisions, they're not as strong as they were over the summer, but we're still getting some healthy moves there. And what's really interesting, Becky, there's so much angst on this AI trade. But people are saying, I want to look at cheap sectors. I want to look at where AI can enhance productivity down the road. So let's maybe talk about things like healthcare. So people are nervous. They're in risk management mode, but they're also thinking constructively.
The AI returns for all of these other sectors, does that actually pay off in 2026? Does it lead straight to the bottom line with earnings?
I think that we are still very early days. I was pleasantly surprised towards the end of this last reporting season that I was actually seeing a few companies in the consumer space actually put out some hard numbers on, say, we had this fulfillment center. We used AI on that. We increased productivity by 30%. Again, very early days, but at least we're starting to get some tangible pointers from companies.
Which consumer companies were the ones that kind of jumped out with that? Where did you hear it?
I can't get into individual companies, but it was more on sort of the retail side.
Okay.
And what was interesting is that my team and I, we read transcripts really, really closely. And as we've gone back over the past years, we've seen things like, a chat bot, right, from like a travel company, things that frankly felt a little bit underwhelming to us.
Yeah.
As we looked kind of in the middle of the year, we felt like business services type companies, that really had kind of deep roots in the tech space were giving us some tangible examples, even if they weren't giving specific numbers.
You mean like replacing call centers type of things?
Replacing call centers. I mean, I will tell you, we see a lot of references to productivities, efficiencies, those sorts of things. But it does feel to me like companies that are a little bit more deeper in the tech world, even if they're not tech companies per se, have done a better job of sort of sounding real, to be honest, when they've had, some of these impacts.
Yeah, I mean, it's one thing to say AI 72 times on a conference call. It's another thing to lay out a clear-cut example where you are seeing efficiencies.
And look, I think that's part of the jitters, right? I spend probably more of my time talking to long-only investors than hedge funds. I have a healthy amount of the latter. But as I went through the summer, I felt like not only were long-only investors, we were sort of talking about what we were hearing on the earnings calls and the companies, but also just in terms of their own day-to-day use cases, right? And I think the idea that a lot of this is still sort of in an experimental phase, we're still figuring out the use cases. I think a lot of people in the investment community have been living that in their day-to-day life. And so then when you also, sort of translate that to the returns you're getting from companies, this idea that this was all going to be transformational tomorrow, I just think for a lot of companies and industries, it hasn't panned out yet. Some it has, right? It's very hard to draw a broad brush, but there was a lot of impatience with this trade from early on. And I think what investors are learning now is you have to be a little bit more patient and give it a little bit more time.
Very quickly, what could go wrong in 2026?
As long as we're not talking about a recession or seriously worried about it, I think the market's going to be fine. When we've talked to investors about what could go wrong, we said watch GDP forecasts for the end of next year. They're sitting at 2% on consensus. If you were to drop even into kind of the 0 to 1% range, stocks are usually down in that environment. Job losses, if we were to get those next year, I'm not so worried about, stuff we have seen necessarily in the fall. But next year, job losses, I don't think would be baked into markets.